One mistake investors make is that they focus too much on the equity part of their portfolio. Most investors don't think much about the debt part of their portfolio. This is because equities have the highest expected returns, so people spend a lot of time thinking about the best stocks and the best equity mutual fund to buy. The problem with this is that investors look at asset classes in isolation. The right thing to do is to think about all your investments as a portfolio and not just the individual components. The role of equities is to generate higher returns, so they are riskier. Similarly, you need a safe asset class in your portfolio to reduce the volatility and also generate some income. This is where debt comes into the picture. When you combine risky equities and safer debt securities, your overall portfolio volatility reduces. There are various ways to get debt exposure, such as debt mutual funds, corporate bonds, and government bonds. If you don't want to take any risk with debt, then government bonds are the best option. Until a few years ago, it was really hard to invest directly in government securities, but you can now invest in them easily on Kite. So, what are government bonds? The central government and state governments have to build roads, provide healthcare, and spend on development. It raises money through taxes and other sources, but that's not always enough. So when the government needs more money to spend on development, it borrows money by issuing bonds of various maturities, such as treasury bills or T-Bills, government securities or G-Secs, and state development loans or SDLs. The Reserve Bank of India is the banker for the government, and it issues these bonds on their behalf. Most governments have a fixed interest rate. Now that we have understood this, let's look at what these different types of bonds mean. Treasury bills or T-Bills, these are short-term instruments with maturities under 1 year. They are issued in 3 maturities, 91, 182, and 364 days. Treasury bills don't pay any interest. They are issued at a discount and redeemed at par. For example, a 91-day T-bill can be issued at Rs 98, but you will receive only Rs 100 when it matures. The difference of Rs 2 is your return. Government securities or G-Secs, these are issued with maturities ranging from 5 years to 40 years. They pay a fixed interest rate that is paid every 6 months and credited to your bank account. The principal is paid upon maturity of the bond. State development loans or SDLs are similar to G-Secs. While G-Secs are issued by the RBI on behalf of the government, SDLs are issued by the state government and has an implicit sovereign guarantee. Hoping you have understood these government bonds, let's see how you can identify them. For treasury bills, the symbol looks like 91-day T-bill. This is self-explanatory. The RBI issues existing bonds and new bonds from time to time. For reissued G-Secs, you will see the symbols like this: 7.18 GS 2037. 7.18 in this case is the interest rate or the coupon. GS refers to the government security, and 2037 is the maturity year. If a government bond is issued for the first time, you will see a symbol like New GS 2033. New GS refers to a newly issued G-Sec, and 2033 is the maturity year. The symbols of SDLs are similar to G-Secs. For example, 6.81% PB 2031 or GA SDL 2031. This interest is paid out twice a year, and you will receive it in your bank account. PB refers to the state issuing the bond. In this example, it's Punjab, and 2031 is the maturity year. You can easily invest in these on Kite by following these steps. Log into Kite, click on bids and then on government securities. Click on place bid against the G-Sec, T-bill or SDL you want to invest in. Enter the amount you want to invest and click on place bid to place the order. The issue date for G-Secs, T-bills and SDLs open during the following days of the week. The allotment of bonds happen as follows. For details about taxation on these bonds, check out the link in the description.